What's up everybody? In today's video, we're going to be going over the 8th and final company on my watch list. These are all companies that I have thoroughly investigated and determined to be great companies that I'd eventually like to own. The only problem is that they are too pricey for my liking at the moment. So what I do is I place them on a watch list and patiently wait for a better opportunity to buy them at a more reasonable price. Because there are 8 of them and the full video is going to be longer than most of you would like, I broke them up into shorter videos on each stock. You'll be able to find all the individual videos by following the link to the playlist right up here. You can also click on the thumbnails at the end of each video and it will take you to the next stock on my watch list. So without further ado, let's get started. Final stock on my watch list is the one and only Costco, ticker COST. I have a much different view of Costco than most. The majority of people view Costco as an elite company. In my opinion, it's mainly because Warren Buffett and Charlie Munger love the company and the fact that the stock just performs. It just does. And over long periods of time too. It's nothing like a fad or a momentum play like most of the chip stocks these days. But Costco isn't elite. It's a strong company, but it's not elite. It's not in the same conversation as Microsoft or Visa. Costco's industry and business model just don't allow for the same level of profitability or cash generation. I know many of you will strongly disagree, so to end this video, I will give you the pro and what I call the not so fast argument for the company. Let's start off with what's not so great. First and foremost, they're barely profitable because of the massive fixed costs that they bear with their huge warehouses, mountains of inventory, and 250,000 employees. They get to keep less than $3 for every $100 in sales. And half of that $3 that they get to keep is because they charge a membership fee, which comes with huge margins. The problem is that their membership fee only makes up 2 to 3% of their revenue, so it doesn't have a large effect on their profitability. Morningstar estimates that the non-membership portion of their business generates a 1 to 1.5% margin, while the membership fees account for the other 1 to 1.5%. Their cash flow margins are no better. They just posted an all-time high of $6 billion in free cash flow in 2023 on all-time high revenues of $240 billion. That's less than a 3% cash flow margin. I can feel the Costco supporters yelling at their screens right now. But they have a wide moat and a 90% plus membership renewal rate. They're meticulous at keeping expenses low through warehousing the merchandise in their stores and displaying them on planks rather than nice, neat shelves. They have significant bargaining ability with their suppliers due to the volume of product that they move. And Morningstar estimates that they hold a 61% market share in the U.S. discount warehouse industry. And my response is, that's great. Those factors make them a good company indeed, but not an elite one. You see, all those factors that I just mentioned resolve themselves in 2 metrics for any company: the profit margin and the cash flows that the company generates, both of which are horrible with Costco. And they make up for it with higher volumes, which they have been successful at. But it doesn't change the fact that they have to work extremely hard just to keep $3 out of every $100. Their industry and business model constrain the company's ability to generate enormous amounts of earnings and cash like you can get in other industries. Then there are the special dividends. Dividend investors love Costco because every 2 to 3 years they pay a special dividend. But you can't just look at one aspect of it. You need to look at total shareholder returns, which includes both dividends as well as share buybacks. They offer only about a 0.5% dividend yield, all because the stock is so dang expensive. Even worse, they don't buy back any shares. What's going on here is that Costco holds on to excess cash as it piles up instead of paying it out in the form of a higher dividend or through quarterly share buybacks like most companies do. They sit on your cash and they give it to you a couple years later as if they're doing you a solid. They're not. They're actually costing investors returns. First, in the form of time value of money. Had they been paying out a higher dividend instead of accumulating the cash, you could have bought shares earlier, giving them longer to compound and generate even more dividends themselves. Or if they bought back shares on a quarterly basis with that money, then they'd be able to report even higher earnings per share than they did, which should result in higher stock price on the shares that you own. In this case, there are nothing special about these special dividends. They know they can increase the dividend or buy back shares. If it's just a one-time payment, then that's one thing. It's another thing to do it 5 times in a little over 10 years. It's obvious that the company easily supports higher shareholder returns. They just choose not to, and it's costing investors. The last knock on this stock is their valuation. Their valuation is absurd, in my opinion. and it's the reason why you find Costco on my watch list instead of as a holding in my portfolio. A 51 forward PE and a 1.5% free cash flow yield is simply unjustified for a company that supports a 3% margin and is growing revenues at around 3 to 5% over the past couple years. Not even high growth tech companies like Arista Networks, Nvidia, or Microsoft, who are growing revenues in the 10 to 15% range and sport 30% plus margins, are trading at such absurd levels. This company is severely overpriced in my opinion, and both Morningstar and CFRA agree. Morningstar puts a $510 fair value estimate on the company, while CFRA estimates their intrinsic value at $700. And I put a $400 price tag on it, but with a 10% margin of safety, I'd only be willing to pay $360. So those are the sore spots. Let's take a look at the qualities that make this a great company, not just one that keeps 3 out of every $100 in revenues. Revenues are growing around 10% per year over the past 5 to 10 years, which is fantastic for such a large company. But that rate has slowed over the past couple of years. You can see the two pops right here where consumers were dealing with a spike in inflation in 2021 and 2022. Those were a bit of an anomaly, with revenues increasing 18 and 15% respectively in those years. Their baseline growth rate is more in the 7 to 8% range, which is still really good for a company of this size. Amazon is on another level, but compare Costco's revenue growth to BJ's Wholesale, Target, and Walmart, all of which are growing slower than Costco. You see a similar story with their earnings, but cash flow is going gangbusters, growing at around 20% per year, which is supporting the 13% growth rate in their dividend. They do carry quite a bit of debt, but they're in a net cash position, so it doesn't bother me too much. I would like to see them pay that down a little though. Additionally, we're seeing some margin expansion over the past 15 years as they optimize their distribution and inventory management model, implement operational efficiencies with digitization and automation, and raise the price of their membership every 3 to 5 years. According to Morningstar, they see Costco's margins approaching 4% over the next 10 years. And even though their margins are low, they are able to maintain and grow their margins that high because of great management and a cost advantage in their industry. They house their mountains of inventory in the warehouses where customers shop, which limits transportation and storage costs. They display their products in a crude fashion so they don't have to carry more headcount to maintain pretty little displays like many of their competitors. They limit the types of products that they sell to about 1/20th of what Target and Walmart do, which reduces inventory procurement and carrying costs. And the huge volume of product that they move allows them to negotiate better terms with their suppliers than their competitors can. All of these support their cost advantage, which allows Costco to offer incredible deals and focus their efforts on volume, which they execute to perfection. Costco generates an outstanding $1,900 of sales per square foot. Compared that to Walmart at $600, Target at $450, and Kroger at $830 per square foot, and they're nowhere close to Costco. Their return on invested capital is quite robust for this industry at around 20%. You may look at that and think it's pretty low compared to the tech giants or Visa or Fastenal, and that is true. All these companies generate much higher return on invested capital than Costco does. But return on invested capital is industry specific because of the different fixed cost requirements that come with their capital light business models. But if we compare the return on invested capital to firms in their industry like Walmart, Amazon, Target, BJ's Wholesale, and Kroger, you'll see that Costco's 20% return on capital is actually quite high. And better yet, it's increasing, unlike Walmart, which has seen their return on capital and margins decrease over the past 20 years. Well, that'll do it. I'd love to hear your thoughts on Costco in the comments. Are you a buyer or a seller? If there are any other companies that you'd like me to take a look at, feel free to leave them in the comments as well, and I'll eventually get around to them. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way to help me grow this channel if you find this content valuable. Lastly, to continue to the next great company on my watch list, click one of the thumbnails that you see on your screen right now. Until next time, you all take care. I'll see you in the next one.